So my name is Vikas Agrawal. I am the founder of AIF and PMS Experts India. So what is AIF is alternate investment funds and PMS is portfolio management services. So we are experts in alternate investment funds and portfolio management services. In fact, we are one of the largest platform in India when it comes to investing in alternate space or in portfolio management services. So as the name of the company clearly indicates that, we don't do anything else other than focusing on only one area, which is alternate investing and portfolio management services. So if you look at, when I was, trying to set up this organization, what was going on in my mind is that, how do I solve a bigger problem, because this space particularly has a lot of problem because this industry is highly scattered, and therefore I was thinking that how do I go about organizing this in a manner where it will be a win-win situation for all of us, in the sense that there are investors who have enough money but don't know how to invest through AIFs and PMSs and participate in Indian capital markets, and there are AIFs and PMSs companies but they don't have right kind of investors to raise funds, and therefore they sometimes miss on the bigger opportunities. For example, if you look at during the last decade, we've grown from one unicorn to almost 100 unicorns. But if you ask me how many Indian ultra HNI investors could manage to participate in this rally, I would say only 1%. And if you look at this percentage globally, it is, you look at, for example, globally, some of the developed markets like US, the percentage is as high as 20%. So the problem is on both the sides. So one is that most of the investors don't know how to participate in alternate investments funds, and most of the portfolio managers and these manufacturers, we call them asset management companies, don't have contact with investors. So we thought we will build the platform. And we'll get everybody on the same page. And when you get everybody on the same page, chances of meeting accident is negligible. And it happens. And I spent 20 years in the industry, and what I've realized over a period of time that many times, particularly investing in portfolio management services, a lot of accident takes place, in the sense that, for example, if you don't have a risk appetite, let's say you have a crore to put money, and your risk appetite do not suggest you to put money in mid caps or small caps because they are very volatile. Sometimes you look at the returns, how the returns are last 5 years, 10 years, and if those returns are attractive, you end up investing there. And then realize when you see the drawdown, because Indian markets are very prone to these drawdowns, and you see major drawdowns coming in. For example, in the recent past of COVID, Indian markets fell down by good close to 37-38%. And then they realize that, I made a mistake and let me take the money out. And when they take the money out during the bad times, they not only lose money, they also lose the confidence, and therefore they don't come back to equity markets or capital market per se. So we thought, why not we'll build a platform. So any organization that you're looking at, what was going on in my mind is there are four P's which are going to play very, very important role. The first P is the platform. I thought I will build the digital platform where I'll onboard these portfolio managers, will onboard the clients, and work together with these stakeholders. So building the platform, when you're building up the fintech, very, very essential and important is to build the platform. The second thing is, okay, once the platform is built, how do we build the product categories? So we thought we'll have two product categories, and that's how the name of the company also came out, which is called AIF and PMS. So we worked on these two categories and started onboarding the portfolio managers who work in this segment only. And we prefer to work with boutique portfolio managers, who specialize in a particular area. So the second P was building the product and proposition. The third P, which is very, very important, is, okay, these two P's are done, then third P is people, so you people. So it's very important that you hire good quality people who are passionate about helping investors to create wealth and don't look at their own benefits all the time. Now, identifying the problem, so you get lot of expertise in India, but finding a good talent with good integrity is a very rare combination and rare to get. So, I thought that I would rather not hire people who do this kind of mis-selling, but I would rather be happy without people. But if I hire people, I would look at what is the integrity they bring on the table, and therefore we are now hiring people and giving them enough support, enough training. And I'm going out of to the extent that I'm hiring people from different industries and helping them to shape up their career in this segment, giving them enough training so that they sharpen their skill, they improve their knowledge, and then they start reaching out to investors and help them to create wealth. So these 3 P's were very, very important, but one P which is very, very important apart from these 3 P's is your process. So, if you follow the right process, you get the right output. If you don't have process in place and everything is ad hoc or haywire, then there are chances that you may not be able to meet your goals. So it is very, very important that you plan things, you plan your financials well, and then put the process in place, and then follow that process very, very religiously and rigorously, I would say. Otherwise, achieving those immense outcome is not at all possible. So we are building on that. So these were the 4 P's. So this is our logo represent, because we are in the business of trust. Therefore, the first parameter that we looked at is how to build the trust amongst investor community. Then the second is we follow the balance approach, because market is the biggest guru in this world, and it teaches you every time. Every time you feel that you're on the bull run and you go gung-ho about investing in various securities, and maybe 2 years, 3 years down the line, you get to know that your approach was very, very aggressive. So it's very important that you balance the portfolio. So we go to an extent of hand-holding our clients that it is always good to have balanced approach when you are investing. You cannot only look at one-way direction. The third thing is, which is very important, is unity. Unity is very, very important, because if we don't have unity, we cannot achieve bigger goals in our organization. Therefore, we felt that unity is very, very important. So we are an absolutely non-political organization. Whoever is doing good job, they get incentivized and rewarded accordingly. So absolutely focused on performance, and there are no other parameters to tell you the truth. Then the fourth thing is stability. Once you learn, once you sharpen your skill, you are doing very well, then you feel at one point of time that it's time to switch or move on. But stability is very, very important, whether it is people or stability in the portfolio. So we look at returns coming consistently. We don't like funds which are like in the Q1 and then next quarter they are in the Q4. So what we do not like is the roller coaster ride. Maybe 1% lower returns we are okay when we are constructing the portfolio, but what we like is the stability in the portfolio. So these were the parameters that we were thinking, because ultimately what we are doing is we are managing somebody's hard-earned money, and we have to be very, very methodical in our approach when it comes to that. So therefore we thought that we will build the organization in a manner where we are really able to help our investors to create wealth in the long run. So we work closely with those families, and we work for long period of time. So it's very important that we aligned ourselves. I've already introduced myself. So I bring about almost 2 decades of experience on the table, and before starting up this organization, I used to work for Motilal Oswal as a senior vice president, and I spent good amount of time on the asset management business, and then later on I moved on to the wealth management segment. So clearly, having worked in both the sides of the table, I have got an opportunity to learn a lot, and as a result of that, we are able to create wealth for our investors, because it's very important when you have a good amount of experience, eventually you tend to develop so-called wisdom in your career. It's very, very important that in markets which is so rapidly, which is changing so fast, which is so volatile, and the entire world is going in a different direction, it's very important that you develop your own wisdom. So fortunately I worked with large organization and got an opportunity to learn a lot. So our aim was very clear that we want to educate and empower the investor community as a whole. And I'm glad to share that there are Cat 2 and Cat 3 cities for example Akola, Amravati, Nagpur, Jaipur, Bhilai, Raipur, Kanpur, Surat. I mean, look at there are many entrepreneurs, and they're growing very fast. They're creating wealth, but they don't know how to participate in capital markets through AIFs and PMSs and take the maximum advantage of this and enhance their overall returns. So therefore we are here. I built up this platform to ensure that we reach out to those people, help them to create wealth, and we've just done the exercise, right, how it works. So our vision is to be the most respected AIF and PMS distribution and advisory platform in India, in the sense that as I said, that if you keep on doing the same thing again and again, you tend to develop expertise at one point of time. Because our right from Pion to myself as a CEO of the organization, all of us are involved in doing only one thing. So when all of you doing only one thing 24/7, 365 days a year, then the magic starts happening after that, because all of you are completely in sync and aligned with each other, and you are able to leverage the strength of your other team member. So therefore we felt that we want to be the most respected, so therefore we don't do anything which can harm our investors. We are not commercial driven. Of course commercial is required to earn our bread and butter for myself and for my employees, but not at the cost of our client interest. So we aligned our interest with our client interest, so that we create wealth. If you don't align your interest with your client interest, then the wealth creation is not possible, is what I feel. So therefore we felt that it is very important to have this kind of vision. As I said, what we do is, so our attempt is to build a digital platform. I have already talked about it. We filter out the funds basis the internal framework and the parameters. So I also talked about process. So let's look at what all things that we do. So this is our core business. So we basically building the digital infrastructure and ecosystem. So we have collaborated with almost 85 different portfolio managers in India, both alternate investment funds and PMS both put together. So we're working closely with almost 85 fund houses. We do complete analysis of the fund. So when you look at, for example, if I tell you that this fund has delivered 20% returns this year, say 50% return this year, you are not sure whether next year the fund will deliver the similar kind of returns or not. So very important that you bring some kind of analysis and research on the table for your investors to be able to decide whether the fund will work for them or not. So I talked about process. So we built up this process internally. Initially we did this for our own proprietary money. Me, my elder brother, and some of my relatives, we've been investing in equity markets for almost 2 decades now. So we felt that it's very important that we build some internal framework. So we built up this framework. What is this framework is all about is, we spend almost 50-60% of our time in terms of understanding that what is the style of the portfolio manager. Because if I am giving your hard-earned money to the portfolio manager, so sometimes what happens that as an investor, if I am choosing 2 different funds and say I have given money to X fund manager and the 50 lakhs to other fund manager, let's say I have a crore to invest, I need to look at what is the style of the portfolio manager. Let's say that both of them are value investor, then you feel that diversification is done, but actually it is a duplication and not diversification, because their style is same. Let's say if both the portfolio manager is following a GARP model, which is growth at a reasonable price, then you imagine, then you feel that the diversification is done at the client level, but it is not, it is duplication. So therefore we are very clear that the way we construct the portfolio is that we pick up different style, and markets keep changing, So at times value would work at times, growth would work at times, contrarian approach would work in the market. So if you have a different style, then your risk is well diversified. So therefore we spend a good amount of time there. We look at the quality of the portfolio. Because we come from research background and we have a team of around 11 people and their full-time job is to do complete research, we understand the quality of the portfolio. It's very, very essential that you understand whether the fund manager is really identifying high quality companies or he is investing based on the way dynamics are changing. Let's say investing in business cycles, he's investing in cyclic stocks, or he's investing in companies which are whose balance sheet is manipulated. So we do not like those portfolio managers, neither we like those portfolio. So because we come from research background, we keep a very, very strong eye on that. In fact, we go to an extent of doing a complete due diligence of checking how many stocks have been bought by the portfolio manager since inception and how many calls have gone right and how many calls have gone wrong. So that clearly indicates that is the portfolio manager really working on high conviction ideas, or he is just buying companies based on the probability whatever stock brokers are suggesting, and he is just buying and selling and doing all sort of work with your hard-earned money. So very, very important that you do this analysis. The third is, as I mentioned to you, that we look at the consistency in the portfolio manager. What we do not like is the portfolio manager who is going in quartile 1 ranking and the very next quarter is in Q4 ranking, again coming back. So we do not like this roller coaster ride at all. We like consistency. Maybe in your Q2 giving 2% lower return is okay, but how consistent you are, and that will define based on the quality of your portfolio. So, and that will also lead to what sort of style that you are managing. So we like consistent managers, and therefore we work closely with them. That's how the profiling is done. I'm not getting into too much detail, but we look at the fund manager's profile. We look at that, what sort of expertise fund manager brings on the table, how many years of experience fund manager is carrying, what is the DNA of the organization. So we get onto the complete details of that. And what is our belief is that long-term investors outperform short-term investors. In the short term, you may see some volatility coming in, and I cannot guarantee, nobody can give you any guarantee how much returns you're going to make. But if you look at last 40 years, your Sensex itself has delivered 13.5% returns year on year of last 40 years of CAGR returns if you look at. So if you have a long-term horizon, when you are coming and investing in equity market, you need to look at long-term and you need to have long-term approach. The other thing is multi-asset class portfolio continues to reap the benefit from diversification. So there are investors who says that, look, I don't want to take too much of risk. What I am looking at is in line with benchmark return or slightly more than the benchmark, but I do not want too much of volatility in the portfolio. So we work that way. Then we construct the portfolio in multi-asset classes, like we invest in equity markets, we invest in fixed income, we invest in gold. We also look at some investments in REIT, which is your real estate investments. So based on that, we construct the portfolio, and then we formulate the appropriate risk budget, because very, very important that most of the clients sometimes they overgo and they overcommit and they're not able to kind of maintain it when the drawdown comes. So very, very important that we create a financial budget for the client. We make a proper planning, and let's say you want to put money, do a proper planning, and then create a budget, and then commit your funds in the markets. The other thing is extreme markets environment occasionally provides tactical asset allocation. For example, in the recent past we saw, because of the Ukraine war, Indian markets fell down by good 15-20%, and that was a good time to enter into if somebody is looking at adding more money. So sometimes we do change the tactical allocation, or let's say somebody is already invested, then we might request the client to top up the existing investment, so that it averages out, And there are times when market goes haywire and the valuation is like 30p, 35p. That is the time we become more balanced and urge our clients to book some profits and come on the cash fixed income market, so that whenever you get an opportunity, you can from there go back to equities. The vast majority of the active portfolio managers in India do justify their fees. Well, there is this perception in the markets that in AIF and PMS you pay more money than the mutual fund. I'm not denying on the fact that that's right to large extent, but thanks to regulator of late, things have shaped up big time. It's become more organized, and now it's very much comparable in the sense that there used to be a time when portfolio managers used to charge so much on profit sharing, etc., etc. But now the new portfolio managers who are entering in, and the regulator focusing more on this and shaping it up, then you don't have now entry load, etc. So if you are paying 1.5%, 2% on the mutual fund side to manage your money, similarly with that money, with that kind of fees, you can also construct your own portfolio, portfolio management services. You can opt for it. So these are the few things. This is very important. This is a selection process. As I talked about the process, very important. What we look at, while investing is, we go like this, we will not go like that. So first thing that we look at is what is the investment philosophy of the portfolio manager, and whether he is sticking to the portfolio investment philosophy or not. Because investment philosophy is something that you make at the initial days of your fund inception, and sometimes it has been observed that there are portfolio managers, they don't have defined investment philosophy, and even if they've defined, they don't stick to it during the bad times. So let's say I say that, look, I am a growth investor, and one of the other day, if I get some companies at a much cheaper valuation, maybe a value investing company, I should not be picking up that company, because I said that initially, look, I am a growth investor. So how are you sticking to that during the bad times or not is very, very important. Investment style I have already covered. I look at investment style, what style do they follow. We look at the very, very important, the investment pedigree, in the sense that what sort of pedigree the organization has. For example, there are organizations which are expert in equities. There are organizations which are expert in fixed income. There are organizations that are good at investing in gold, silver. So each of these, so we look at what sort of DNA do they have. DNA is like a long history, pedigree of the organization, and they've been doing this. So I'm sure while doing this, they would have made a lot of mistakes, and they would have learned from those mistakes. So therefore, very, very important. Third is fund manager experience. So we look at that, what sort of experience do they bring on the table, how long they've worked in the organization, in the previous organization. Sometimes what happens that fund manager also keep changing their job so frequently. Like 1 year they worked in this fund, the second year they got 50% increment, they went on to other company, they started managing that fund. After 1 year they leave, join third company, which means that the fund managers that fund manager does not have vision. So he's only working for himself and not for the benefit of the investor, and therefore he's changing the jobs over. So we do not like those kind of managers. So that needs to be examined when I talk about experience. ऐसा ना हो कि somebody is managing fixed income, and then here he's been given the assignment of equities. Now the gentleman doesn't know anything about equities, right? Just because somebody else would have left and he would have come in his place, there are chances that investor meet with an accident, right? Or he will commit some major mistake. So we do not like that. The performance of the scheme, as I said, we like consistent performance. We do not like roller coaster ride. Track record, very, very important. Track record in the sense that what kind of track record the fund manager has and what kind of track record the scheme has. Because longer the time horizon, the better it is for you to understand the capability of that fund house. If the fund house is delivering 20% returns for 20 long years, that clearly indicates the capabilities of the fund house, that no matter where the markets are or no matter how they behaved in the past, the ultimate is 20% CAGR for 20 long years. That's a remarkable achievement to my mind. So therefore, very, very important to look at the track record of both the fund manager and the fund house. Then the consistency I talked about, that we look at consistent portfolio manager. We look at the quality of the portfolio. We look at the AUM size also. It does matter. Fund should not be too big that somebody is not able to manage, and it should not be too small that it can have major impact in your portfolio. So very important aspect. Then the investment theme, what sort of theme do they follow? It's a banking theme or a pharma theme. So that also we examine. So why somebody looks at us? So because as I said that we are one of the fastest growing organization in this segment. Uh, Now our organization, the total number of people we've grown to now 14 of us now, out of which 11 of them are involved in doing research work. And so we look at experts and we've got qualified team put together. A total experience of a team is about 50 years. So that clearly indicates I myself bring about almost 20 years of experience when it comes to capital markets, and then I have other colleagues who are expert in their different areas. So these are ex-bankers, and we follow the selection process I talked about very religiously and rigorously. We follow a very unbiased advisory. Because we are a data-driven organization, we put out all the performance of all the portfolio managers in our website, so that tomorrow nobody can say that we were biased on any aspect. We put out the numbers, outcome is in front of you. Based on that, we discuss with the client. Based on that, we understand their risk profile and then get aligned. So we follow unbiased advisory and we look at the consistency score. How do we add more value to clients? Is we do a lot of interactive sessions. Every week we organize. I don't know if you got a chance to look at our YouTube channel called AIF and PMS Experts India. Whenever you find the time, please go to. We've got more than 5,000 subscribers over there, and we educate, as I said, our aim is to educate and empower every investor. So we add a lot of value to them in terms of, we run a show called Ask the Expert Show, in which we invite industry experts and I interview them, I read their minds. And that's how, message goes to the investor community as a whole, and they take advantage of that. We do, thanks to technology, earlier, if I would have said that let's meet over the Zoom call, you would have said, what is Zoom call? Now today, every investor and the fund manager has become more of comfortable or familiar with these tools, thanks to technology. So we meet more often. Suppose somebody has invested 50 lakhs rupees, and suppose during the lockdown time, his friends and relatives, everybody would have said that this is the time to redeem the portfolio. That is the time we connect with the fund manager and handhold the clients that this is not the time to sell, it is the time to add more money rather. Yeah. So we have a dedicated relationship manager who work very closely with these families, because ultimately we are managing somebody's hard-earned money. So we cannot have a sorry face at all. So chances of making error is negligible. Investment team clients risk, we do complete risk profiling. We have 24/7 access to portfolio, because we are the only one who's providing access to the portfolio, different portfolio management companies in one app, which is called AIF and PMS Experts India. We're very focused and we follow these processes very religiously. So that's it from my side. Apart from that, if you have any questions, I am happy to answer. Yeah.
You said investors should. You said that the investor should not change his theme of investing or the style.
Yeah.
He's a value investor. He's not investing in value.
Yeah.
But so like Warren Buffett also famously strayed away from that strategy when he met Sullivan. So.
Yeah. So very good question. As in, thank you for asking that question. See, when you if I am the wealth manager, I am running a wealth management firm, and if I am taking 1 crore from my client, and if I am dividing into different style, it is very important for me to know what style you follow. If you change your style overnight, then my asset allocation gets changed completely. So therefore, we like to work with those portfolio managers who are very clear that they don't want to change the style of the portfolio till the time the portfolio is alive, So that gives us more clarity in terms of how do I construct my client's portfolio based on their risk appetite. So somebody is a value investor or somebody is a growth investor, and your risk profile is not allowing me to go to a value investing fund, then I may not be able to allocate the money there. So when you are managing, so there are two things. One, you managing your public money. The second is you managing your own self proprietary money. So when you are managing your own money, you are free to do what you want to do. If you don't want to define your framework, that's okay. But there are times individual investors also come out with saying that I want to define the framework and work in that way. So there is nothing right and wrong about it, but it is good that the way we work is, the way we construct the portfolio is by talking to portfolio managers, understanding their style, and then allocating the money based on the risk appetite of the investor. Understood? Okay. Next. Yeah.
Clients have a dedicated relationship manager. So do they have only one relationship manager or multiple? Because one relationship manager will have a certain style of investing, so to say. And what if the investor wants, like, he wants to diversify? So they have different relationship managers for that? Or
Yeah. That's a very good question. So it's like, let me answer this way. When you go to Pizza Hut in Delhi and you go to Chennai, you get the same taste, right? If you order any pizza. How it is possible? Because they follow a process, a recipe, which is nothing but a process at an organization level. Similarly, our relationship manager is equipped in a manner that they have to follow our investment Bible. And what is our investment Bible is our own process and framework. So the relationship manager cannot be biased towards any particular area, and it is not possible also humanly to have multiple managers for different style. It's not possible. So therefore we are very methodical. So we provide few questions to our clients. The way you guys give psychometric test, similarly we have few I would not call it test, few questions for our clients. Based on that we generate the score, and the score gives the idea to the relationship manager whether he is aggressive, moderate or conservative, and based on that the alignment of the portfolio will take place. You understood? Okay. But that's a very good question. Thank you for asking. Yes, so that's a very good question. So when it comes to style of the portfolio manager, now please understand that the style of growth investing is not stopping the fund manager to change the portfolio. It is not stopping anywhere the portfolio manager to change the weightages of the portfolio. But what is stopping the portfolio manager is not to go beyond the framework or the universe which was defined initially and pick up the stock from outside of the universe. So suppose I have 100 rupees and I have put 50 rupees in GARP, which is growth at a reasonable price. I don't expect that guy to go and pick up some value stock for me, because for value I have done already the allocation to some other portfolio managers. So the moment he is going out of the flavor and buying those businesses, my asset allocation at an investor level will get changed, which I don't want to. So, but at the same time, these portfolio managers are absolutely free to take their own call in the segment in which they have decided to launch the scheme, and they stick to their investment objectives, stick to their investment philosophy, and stick to their own style of investments for a long period of time. Because in one particular scheme, there are many investors, there are many investors who come and join. So if they change the style, it gets affected at the portfolio level amongst all the clients. So therefore it is very important that we like portfolio managers who are sticking to their own style. Yeah.
So when we are investing in a project,
yeah.
So there is not a possibility that there will be continuous growth. There can be losses as well.
Yeah.
So how do you tell clients that we should stick to that project?
A very good question. So, what happens that the moment you put money in equities, you're talking about equity as an asset class, yes, right? Equity markets are supposed to be more volatile. History suggests that even if you look at last 40 years of data point, while the Sensex or the Nifty has ended up delivering 13.6% returns, the CAGR returns, but it has gone through its own difficult time. For example, Harshad Mehta time when market tanked by almost 50-60%. Then you had a dot-com bubble in the year of 2000 when all the IT stocks collapsed, right? Then you had 2007 when Lehman Brothers crisis took place, and most of the global markets and the Indian markets fell down and melt down to the extent of 70%. Then you had a COVID time, I'm talking about the major one, 2020 when entire globe fell down by good 35-40%. So equity markets are very, very volatile. So therefore, very, very important that you should understand the risk before you invest. If your risk appetite do not allow you, and therefore we do this work of knowing your profile, doing this test, I would say, kind of, wherein we get to know the profile. If your profile is not allowing, if your risk appetite is not allowing, then equity is not the asset class for you. But if you are taking risk, if you are okay with your money going down by good 25%, then only it is for you to come and be a part of equity markets. Otherwise, no. Because equity markets it is in the nature of the equity market to be volatile. Therefore, it is called share market, right? So, share will go up, share will go down. But there is a methodical way of looking at it. If the organization is growing, at 15% year on year, and I can give you many examples, you look at their stock prices also go in the same lines. So, there is a saying that stock markets are nothing but slaves of the earnings. So it's a reflection of your economy. So therefore, there are ways of looking at it. But yeah, coming back to a question, it's very, very important that you need to accept that or understand your risk profile first, and understand that equity markets are very volatile, and during the journey it can go down by good 25-30% also. But if you stay invested for long period of time, say 7 years, 10 years, then you are going to make good money. So we've done the analysis and realized that there are 4 different asset classes. You have equity, you have fixed income, you have gold, and then you have real estate, right? All 4 of them, equity has outperformed all the asset classes in the history of last 40 years in India, ever since you have indexing and you are able to index the stock markets. So longer the period, the better it is. But when you buy a house, you tell me how many times you go and check the value of your house. When you buy a gold for yourself, how many times you go and check the price of the gold. When you invest in fixed deposits, how many times you go and check your FD valuation. But when you invest in equity, your thought process is that you are completely towards looking at the valuation of equity markets every day. But that's not the right way of creating wealth. When you've invested, you have to give some period of time to the portfolio manager to be able to perform or outperform the benchmark. So the minimum threshold, it has been observed, we have done the analysis that if you hold on to a good quality stocks for 3 years, the chances of making negligible return is only 1%. And if you have more than 5 years of horizon, then you can't lose money. You need right brains to lose money. On a lighter note. So I'm saying that if you invest in equity for longer period of time, you create more wealth. Okay, done.